Welcome back to IPO Mania.
This December, two of the year's biggest IPOs took place back-to-back, DoorDash and Airbnb. Their respective valuations have soared in the immediate aftermath, leaving some question as to whether an IPO bubble is taking shape. For more on this, we're joined by good friend John Jannarone, who is the editor-in-chief at IPOedge.com. John, great to speak with you here this morning. Before we dive into these IPOs, these powerhouses, why do you think companies decided that 2020 was the right time to go public with all of the uncertainty that we find ourselves in?
Hi, Brad. Thanks for having me. Hi, Kristen. You know, it's really funny. If I think back to March, talking to investment bankers, to hedge fund managers, I mean, the conversations that I was having at the time were basically about when in 2021 IPOs would ever happen again. But lo and behold, everything came roaring back. And something I think we're going to touch on a little bit later is the SPAC market, which is basically half of the IPOs this year. And that's really what drove most of it. So, I mean, more than half of the IPO volume this year has been through SPACs. But, you know, as I think we're going to dig into in a minute, Airbnb, DoorDash, some of these monsters, these big unicorns have also come through. And that's because the market has come back so strongly and investor confidence is very high.
We got to ask you about Airbnb, John. It's great to see you today. I mean, a valuation of roughly $100 billion soaring out of the gate. Is that justified?
You know, I don't think it is. I think that, unfortunately, both of these big ones that came in the last couple of weeks were great for IPO investors, but perhaps not so great for anyone who bought them in the aftermarket. I mean, I think I was on the air last week talking about DoorDash. I would say the same thing about Airbnb. The valuations are pretty insane, frankly. But, you know, these are such hot companies and they're good companies. So I don't want to, you know, cast aspersions on them in that regard. It's just that they're very, very expensive. And if you want to talk about Airbnb for a minute in detail, what frustrates me a little bit about this is that you're seeing the margins decline over time and revenue growth is also slowing. So that's a little bit worrisome. I mean, if it were me making an investment in the sector, I prefer Booking.com, BKNG.
Interesting, more so than Airbnb. We know that some millennial investors, though, they like to invest in what they know, what they use. And when we talk about growth, even though sales are slowing, once we get to the other side of this pandemic, I mean, how big is its total addressable market? Do you think it does have areas where it can expand?
Oh, yeah, totally. Look, this is a great business. You know, I've seen Brian Chesky speaking in the last couple of weeks. He's also, I think, a great founder and leader of the business. You know, I just think that the stock is very pricey. But what was remarkable was how much their sales started to spring back. And something that I've heard other executives talking about, Greg Maffei from Liberty Media, you know, what he said was that, you know, people still want to go out and travel and have fun. Perhaps we're going to do more of this Zoom stuff for business work, but I think absolutely that there's going to be immense demand for this going forward, and it's a fantastic business.
Okay, and so let's switch gears to DoorDash as well, John, while we have you, which has had a strong market share in the food delivery space, more than 50% as of October sales data. Now, skeptics like Citron Research, they've called it the most ridiculous IPO of 2020 as investors sent this share price soaring 86% from its IPO price on first day of trading. So do you share that same sentiment as a research firm such as Citron?
Yeah, I mean, I think it's a stretch to call Citron Research, frankly, Brad. But yeah, it was a hit job. But look, I think it's expensive. But again, like Airbnb, it's a fantastic business. What's astounding to me is that DoorDash has half the market, 50% market share. I mean, it's unbelievable. But, you know, again, I like to bring up some of these companies that are a little bit off the radar, and I've discussed them with you before. You look at Waiter Holdings, a regional player. It's trading at a reasonable multiple on an EBITDA basis, and it can be taken out by someone like DoorDash. So I think that, you know, for investors who are looking to get exposure to this space, and as you said, you know, the old Fidelity Peter Lynch model, invest in what you know. Sure, we all know food delivery now, don't we? But I would just be wary of the price. But, you know, to suggest that there's something that's going to cause this stock to crack, I don't know about that. And that's the worry. That's what bothers me about something like Citron. You know, and it's not that hard to come up with a conclusion that the stock is expensive. I think that over time, that something like DoorDash is going to be very powerful, because once you have that app on your phone, and, you know, I'm using myself, you know, you get this free delivery over $12. They're doing these things. They have fantastic customer retention. And I think you also care about who's delivering your food. So, you know, whereas, you know, if I get to the airport and, excuse me, I can take an Uber or a Lyft, I think I do care more about who's delivering something I'm going to eat than, who's taking me home from LaGuardia or JFK.
Noted.
Interesting. Okay, John, another question for you. One company that got a huge reception in the early days, but then crumbled a short time after that with a slew of headlines and certainly calls from short sellers was Nikola. This EV truck maker been accused of misleading investors by short sellers, and founder Trevor Milton actually leaving the company. Do you think that Nikola does have a future? It's still a publicly traded company. And what lessons can be learned from this IPO in the aftermath?
Well, this was quite a dramatic story, wasn't it? So, when they got in trouble for the car not actually running on its own power, that was a little bit scary. And, some people, by the way, like to blame SPACs, the SPAC mechanism for that, which is completely unfair, by the way. But look, there's so much pressure to be the front runner in this EV world. We actually did an event about a month ago that you can check out on IPOedge.com, where we had several of these executives from electric vehicle companies, charging companies, battery companies, et cetera. I think that, this business is probably just fine, but look, this is a very young CEO who's out there, who's being very aggressive, and, he got a little too far over his skis. Again, if I can pivot once again, I like Canoo, which is being purchased by Hennessy Capital Acquisition, and that's ticker is HCAC. It's up a lot. I think it's up about $19 from $10. They're making electric vehicles, but they just announced or revealed yesterday their B2B model. So this is for last mile delivery. So you're thinking about things being sent very short distances, which is a huge market. Everyone always thinks about the consumer market. We all want to look at what the cool new car looks like. But what really, I think, makes good business is something like that, where suppose Canoo ties up with Target, Walmart, whatever, and they have these very, very efficient vehicles delivering to homes. I think that is where there's a really big opportunity. So, don't just think about Tesla and Nikola. There are several of them out there. So Canoo is the one that I would focus on.
All right, thanks so much. John Jannarone, editor-in-chief at IPOedge.com. That's all we got time for today, John, but we got to check back in the future.